Then we can talk about what I'll call the dot-com crash. And again, this is probably NASDAQ oriented, but peak to trough, the NASDAQ was down, I believe it was 81%, but that wasn't a single day like 1987. It was like 2.5 years or something.
Yep.
It was a long death by 1,000 cuts. Again, certainly a crash, but not very opposite of the 87 crash.
Correct. It was just so stocks, specifically .com type stocks, had a real big movement downwards. And then everyone's like, okay, maybe we're settling in here, getting a bottoming point. And then what happened for 3 years? 2000, 2001, 2002, it just kept going down. And you'd get a bear market rally, and then it'd sell off again. And you'd get a bear market rally, and it would sell off again. And it was just this stomach churning process that seemed to never end. And it made a lot of people become non-investors for the rest of their life, which is obviously, there you go. There you go. Explain. Yeah, give us your take on this.
No, I mean, that was the environment I lived through. Again, the stock that I was trading was Cisco Systems for the majority of it. Near as I can tell, I haven't looked today, but it hasn't gone back to its high in 20 years.
20
and I think there's a couple of stocks today that will never see their high for 20 plus years. And they're the cult stocks. Cisco, what people don't understand is we have cult stocks today, just like Cisco was the internet.
Yep.
It was the internet. It was the thing. And there were points in time in that cycle where we have not gotten back. If you are holding on to Cisco, you have dead money for 20 years. Can you imagine dead money?
So hard. That is so hard. Because listen, like here's a really good rule of understanding how quickly your money doubles. So what it is, it's called the rule of 72. You've heard of this. So you take 72 and you divide it by whatever the rate of return is that you've experienced. So a normal rate of return is maybe call it 8%. So 72 divided by 8, your money should double every 9 years. This is Michael talking about zero gain over 20 years. You should double 2 times in that period of time, and you've gotten zero return.
Yeah, so there's some dead money sitting on people's portfolios because, hey, I bought X, Y, or Z company at some price, and it's down 30%, but I'm going to wait to get to even. Even could be a long way away.
Yeah. The whole notion of the fact that if you lose 25% in the stock, you need to get 33% back. If you lose 50% in the stock, you need to get 100% back. Like that is something that's so, so important. And that's why we preach diversification ad nauseum, because listen, diversification causes you to lose less money. How do rich people get rich? They don't lose. They don't lose as much, right? And so that causes them to not have to gain as much. And their upside isn't going to be the hyper upside that maybe a retail investor saw in 2021. But guess what? They're not down 39%, which is what the average retail investor was down in 2022. That's a JP Morgan stat.
Wow.
39.